The Nasdaq 100 Open is incredibly violent. The market expands and contracts with massive, rapid energy waves. A 20-point stop might seem like enough room on a quiet afternoon, but during an opening expansion, price frequently wicks through these levels before reversing. As seen on the left, a fixed stop remains static while the market's noise expands, often resulting in an exit before the trade has a chance to develop. That expanding channel on the right is what we call the dynamic ATR buffer. It uses the average true range indicator to measure volatility and forces your stop loss to expand and contract with the market itself. In this session, we are going to walk through the exact sequence to calculate this dynamic stop loss and show you how to lock down your dollar risk to the exact penny. To execute this protocol, you will need a 5-minute Nasdaq chart, your average true range indicator set to a 14-period lookback, and a strict maximum dollar risk per trade. For this tutorial, we are capping our allowable risk at exactly $300. Surviving this market means you have to stop treating your stop loss as an emotional comfort blanket. It must be treated as a strict, fluid, mathematical parameter. Here on this 5-minute Nasdaq chart, the price candles are dipping down to test a technical moving average line, establishing a clear structural floor. Step 1 is simple. We wait for the structural trigger candle to fully complete. In this case, we are looking for a verified floor reclaim, meaning the candle closes securely back above our moving average. While that candle is forming, you do absolutely nothing. You exercise strict patience and let the countdown timer run out. Once the candle is closed, we move to step 2, reading the volatility ruler. A common error is looking at an ATR value from earlier in the session, but market energy shifts constantly. By placing the crosshair tool strictly over that freshly completed trigger candle, the ATR indicator highlights exactly 16 points. The measurement bracket overlaying the candle proves the average 5-minute candle is currently moving exactly 16 points from top to bottom. This measurement identifies the market's current noise floor. If a single candle is averaging 16 points of movement, a 10-point stop is positioned directly inside that normal range, making it highly likely that random price fluctuations will hit your exit before the trend can confirm. To build out our protection, we move to step 3, calculating the dynamic shield. We achieve this by taking our raw ATR value and applying a specific institutional multiplier. This graphic overlay details the exact formula. We take our 16-point ATR and multiply it by 1.5. This calculates a required distance of 24 points to push our risk parameters outside the current algorithmic noise. Now we move to step 4, hard-coding this exact calculated coordinate directly onto our trading chart. You anchor your stop loss exactly 24 points below your execution coordinate or liquidation wick. As the cursor clicks into place, this glowing red envelope instantly renders, locking in our precise defense line. By tying the stop loss distance strictly to this formula, you are mathematically insulated from the normal, expected intraday pullbacks of the active session. This introduces a critical requirement. A wider, dynamic stop inherently means you are risking more capital if you keep your contract size completely static. That brings us to step 5, calibrating the payload. This is the mandatory process of adjusting your contract size down to maintain our strict $300 maximum risk rule. On the left side of this order entry panel, look at the financial risk for trading one full Nasdaq contract. Our 24-point stop distance at $20 per point generates a risk of $480. A $480 risk breaks some strict $300 parameter. To stay within our risk profile, we must scale down the payload size. The solution is to switch execution over to micro Nasdaq contracts, or MNQ. This provides the granular risk control necessary to match your position size to the volatility. Moving to the right side of the order panel, calculating the risk per MNQ contract at $2 per point equals a $48 risk. Dividing our $300 maximum risk by this $48 micro-contract risk gives us exactly 6 executable MNQ contracts. By scaling your contract payload in inverse proportion to your stop distance, you maintain a fixed dollar risk. This allows the trade to breathe within its mathematical requirements without increasing your total capital exposure. Watch this fast-forward sequence of the 5-minute chart. The price whipsaws sharply, driving a wick down 18 points to test the floor. It comfortably misses our 24-point dynamic shield envelope, then rockets upward into profit. A trader utilizing a static 20-point stop would have been stopped out at the bottom of that 18-point whipsaw once spread and slippage are factored in. This table is the Volatility Shield operational matrix. Take a screenshot of these distinct market phases, ATR values, and position sizing rules right now to ensure immediate repetition on your next session. Professional trading requires moving beyond arbitrary fixed expectations. You must measure the true volatility, calculate your shield, and adjust your payload to match the market's fluid energy with mathematically calibrated risk parameters.